Oh, there's so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless. Welcome to The Explainer. Today, we're going to tackle a subject that, let's be honest, can cause a lot of anxiety: the real financial cost of not getting your taxes right. We're going to break down exactly what happens when things go wrong, from simple, honest mistakes all the way up to deliberate evasion. So, what really happens? It's a question I bet a lot of you have thought about. Tax law is just, well, it's notoriously complex, and it's pretty easy to feel like you're in over your head. So, what are the actual consequences if you make a mistake, or worse, if you're dishonest on your return? This whole explainer is designed to bring some clarity to those penalties, so you know exactly where the lines are drawn. All right, here's our game plan. We'll start with a quick intro to what compliance really means. Then we'll walk through the penalties for basic filing errors, the much higher cost of dishonesty, and the really severe consequences of criminal tax evasion. We'll also dig into that tricky gray area where tax avoidance becomes illegal evasion. And finally, we'll show you how there might be a path to relief. Okay, let's dive right in. The entire foundation of tax law really boils down to one simple but absolutely critical distinction. What's the difference between a genuine mistake and deliberately trying to cheat the system? As you're about to see, the consequences for each are worlds apart. All right, moving into Section 2, let's talk about penalties for filing errors. Now, this is where most people get tripped up, just the simple act of filing your taxes late. So let's look at the direct financial hit and break down exactly how those penalties are calculated. So the whole thing really hinges on whether this is your first time messing up or if you're a repeat offender. For a first-timer, you're looking at a penalty of 5% of whatever tax you still owe, plus an extra 1% for every single month you're late up to a year. But if you fail to file again within 3 years, the consequences escalate and they do it fast. The penalty literally doubles to 10% of the unpaid tax plus 2% per month for up to 20 months. Being a repeat offender gets incredibly costly. Let's put some real numbers to this to see how it works. Let's say you owe $20,000 in taxes and you end up filing 4 months late. Right off the bat, you get hit with that initial 5% penalty, which is $1,000. Then, on top of that, there's the monthly penalty of 1% of what you owe. That's another $200 a month. So, over 4 months, that adds up to another $800. You put it all together and you're staring at a total penalty of $1,800. This just goes to show how a simple delay can turn into a really significant financial hit. I mean, that's nearly 10% of your original tax bill, just for being 4 months late. Okay, so we've covered late filing, but now we're going to ramp things up with Section 3. The cost of dishonesty. This is where we move way beyond simple delays and into the much more serious territory of making false statements or leaving things out on purpose. Now, a really important concept here is something called gross negligence. See, the law doesn't just punish you for intentional fraud, it also comes down hard on conduct that shows you were basically indifferent or had a reckless disregard for your tax obligations. This could be something like ignoring a bunch of notices from the tax authority or claiming business expenses you know you never really tracked. The key takeaway is you can be held liable even if you didn't explicitly intend to defraud them, as long as your actions were just that careless. And this isn't just my interpretation. This is the actual wording from the Income Tax Act. The key phrases to focus on are knowingly, which means you did it on purpose, and under circumstances amounting to gross negligence. That second part, well, that's the one that gets people. It means you can't just play dumb if you really should have known better. It's a pretty high bar. So, what's the damage? For you, the taxpayer, the penalty is either $100 or a whopping 50% of the tax you tried to understate, whichever is more. But here's the kicker. The law also holds your advisors accountable. Any tax preparer who helps make a false statement can face a penalty of at least $1,000. It's a really clear signal that everyone involved in preparing the return shares the responsibility for getting it right. And that brings us to Section 4, and this is where things get really serious: criminal tax evasion. At this level, the consequences just explode, moving beyond just money to include the very real possibility of prison time. This is for cases where willful, intentional deceit is proven in a court of law. Now, when it comes to criminal tax evasion, cases are generally handled in 2 ways. The first is what's called prosecution by summary conviction. Think of this as the path for serious but maybe less complex offenses. These cases are usually resolved by a judge without needing a full jury trial. And don't let the term less complex fool you. The The penalties here are incredibly severe. The fine can be anywhere from 50% all the way up to 200% of the tax you tried to evade. Yeah, you heard that right. You can end up paying double what you owed just as a fine. And on top of all that, you could be looking at up to 2 years in prison. Then there's the second, much more severe path, prosecution by indictment. This is a more formal process, often involving a jury trial, and it's reserved for the most serious, large-scale, or really complex tax evasion schemes. And here, as you can probably guess, the consequences jump up a big notch. The minimum fine starts at 100% of the tax you evaded, and it can go up to 200%. And the potential prison sentence, it more than doubles to a maximum of 5 years. This really shows you just how seriously the legal system takes willful tax evasion. This brings us to a really fascinating and, let's face it, often confusing area. When does legitimate tax avoidance cross that line into illegal tax evasion? Well, there's a special rule designed to police this exact gray area. It's known as the General Anti-Avoidance Rule, or GAR for short. So what is this GAR thing? Think of it like a safety net for the tax system. It allows tax authorities to shut down benefits from transactions that, while they might be technically legal on paper, go completely against the spirit of the law. So if a deal is cooked up purely to exploit some loophole for a tax break, GAR can be used to cancel that benefit. Now, there are no criminal penalties with GAR, but you do have to pay back all the tax you avoided, plus interest. So what kind of thing gets you flagged for this? It all comes down to identifying what's called an avoidance transaction. This is usually a transaction, or maybe a whole string of them, where the main goal isn't a legitimate or bona fide business reason, like expanding your company or buying new equipment. Instead, the primary purpose is just to get a tax benefit. If the whole point of the deal is to save on tax, it can be challenged under GAR. Okay, I know we've been talking about some pretty heavy stuff. Penalties, fines, even jail time. But for our last section here, let's talk about some potential good news. It's really important for you to know that the system does have a way to be fair when your circumstances are truly beyond your control. This is all handled through what are called the taxpayer relief provisions. Basically, you can apply to have penalties and interest waived or canceled, but you need a very, very good reason. We're talking about things like natural or human-made disasters, like a flood or a fire that destroys all your records, or serious personal hardship, like a death in your immediate family or a severe illness that physically prevented you from filing. It can even apply if there was a major service disruption, like a postal strike, or if the tax authority itself actually gave you misleading information. And that really brings us full circle to the big question you should be asking yourself. Now that you know the rules, is your tax plan compliant? Because at the end of the day, understanding all these consequences isn't about being scared. It's about being empowered. Knowing where those lines are drawn, from a simple mistake to gross negligence to outright evasion. That is the first and most important step to making sure you always stay on the right side of the law.